When the results came in, I was shocked. It didn't make sense.
We just kept finding all these strange stocks. It was bizarre.
Today, infrastructure sells, but with the current trends in listed infrastructure, we could see serious damage to the infrastructure asset class.
EDEC Infra researchers have now reviewed the documentation, weights and constituents of 144 different listed infrastructure funds, representing close to 90% of this $60 billion sector. What they found was disturbing. Half of the 2,000 stocks in these funds had nothing to do with infrastructure investment, but included blue-chip industrial firms, major software, automotive, banking, and even retail brands. Outperformance was non-existent. Using their actual constituents and weights, listed infrastructure managers taken together do not achieve a better risk-adjusted performance than the leading broad market indices.
These funds offer zero alpha and a beta of 1. The marketing brochures talk about long-term stable returns with inflation correlations, but they're just long-only equity funds.
Why oppose listed infrastructure to listed equities? It's the same market. Makes more sense to invest in factors than to pay more fees and invest in the segments of the same market.
In principle, listing a firm should not change its business characteristics. The issue is one of access. The immense majority of infrastructure projects are not listed, and most listed infrastructure managers have never done a private deal. In the end, listed infrastructure does not produce new infrastructure investment.
The fake infra phenomenon is not new. When a transversal theme like infrastructure becomes fashionable, it can be difficult to regulate. But these listed infrastructure products will disappoint and could make investors walk away from the real thing. We're calling for regulatory action to protect the name of infrastructure investment.